Good morning, my dear future chart accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes, thank you. Today we are going to do overview of this one uh, repeated area again from exam point of view, disposal of forward contracts. Again, I understand on a bright morning, cool morning, on a December month, this weather, very difficult to concentrate. But as people say, no pain, no gain. Let us take a look at what is this forward contract is all about. Basics, I hope you're already aware of it. What is a forward contract? It's a contract entered today for settlement at a later date. Right? So let me just give the quick recap of that. I hope you know it. Forward contracts means agreement entered today. Agreement entered today, but to be settled at a later date. To be settled at a later date, and more importantly at a rate determined today, at a rate called as forward rates, at a rate called as forward rate. Okay, so if you think from bank point of view, what is that bank is going to do? Please think transaction from bank point of view. Bank will have a transaction with the customer, with their client, and they will have a position in the interbank market. Interbank market. The transaction with the customer, that rate is called as a forward rate. And the transaction what they have with the interbank market, do you remember by any chance? The bank will have a transaction with the customer, the forward contract what we're telling, forward rate. But what is the rate that bank will have with interbank? And that is called as the cover rate. Now, if bank is selling to customer, then bank will buy from the interbank market. If bank is buying from the customer, then they will sell it to the interbank market. So think from bank point of view. So if they're selling to customer, they will buy from the market, interbank market. If they're buying from the customer, then they will sell to interbank market. A very basic idea of forward contract. It's a contract entered by bank with the customer either to sell or to buy, but settlement will take place at later date, but the rate is decided today itself. So when bank have a transaction with the customer, they will always have a corresponding transaction with the interbank to protect their position, either to buy or to sell is called as cover rate, and this will be opposite transaction of what bank does with customer. So if the customer, if they sell, they need to buy. That's like that. Opposite transaction with the interbank, that's called as cover rate. Okay, so this is the basic idea of forward contract. Now there are uh, three broad situation possible and total 9 situation possible. On the due date, what is the due date? I told you, no, at a later date, settlement date. In futures, it's called as expiry date. But in future, it will be a fixed date. Standard month end expiry. But forward is between two people, between bank and customer. Any dates they decide. The date on which the settlement is going to happen is called as on the due date. So on the due date, customer executes, everything happens smoothly. On the due date, customer comes and say, cancel, I don't want this contract. How that is going to be done? Or customer can tell, no, I don't want to extend, I don't want to execute today, I want to extend. These are the information where the customer can give you bank on due date. Or before the due date, customer can say, I want to execute its execution early settlement. Or before executing, he says, I'm going to cancel. And before the due date, he says, I would like to extend it. After the due date, on the due date, customer does not come. He comes later and wants to execute, want to cancel, want to extend. So 9 situations possible. Please write it down. This 9 situation possible. So we have to understand, when a problem comes, among these 9 situation, which situation is going to occur, and appropriately what charges will happen there and what transactions will happen there. Mostly from bank point of view. In some cases, we can also think from customer point of view for easy purpose, but mostly it is from bank point of view. I will show it to you, the calculation. First you write down. First write down this 9 situation. So on the due date information. On the due date. See, when I say on the due date information informs the bank. On the due date, customer inform the banks. Customer informing bank. Before the due date, customer informing the bank. Customer informing the bank. And after the due date, customer informing the bank. Customer informing the bank. Write down these 9 situations. I'll give you a few examples and let us see whether you can identify which situation applies. Customer informing the bank, on the due date I would like to extend, I would like to cancel, I would like to execute. Okay, hope you've taken it down. On due date, before due date, after due date, same 3 situations: execute, cancel, extend. Okay, hope it is done. Now, I'll give you a few examples. Suppose on 1/1/2022, you have entered into transaction for 3 months contract. Means due date is 31st of March 2022. Now you come to the bank on 31. You come to the bank on 31/3/2022 and you say, I would like to cancel the contracts. Now, can you tell me which situation this will fit to? On 31st of March 2022, he is coming and telling, I would like to cancel the contract. So, this fits which situation? On due date, cancellation. He is cancelling. On the due date, he is cancelling. If he comes and say, yes, let's execute it, on the due date, he executes. Okay. Now, one more situation. He comes on 28th of February 2022 and says, I would like to cancel. He's informing earlier only, 1 month early, he's informing early information that I would like to cancel. So which situation this will apply to? This will be before due date cancellation. Before due date only is informing. And on 28th February 2022, if he tells, I want immediate settlements, then in that situation, this will happen before due date execution. Because on 20th February is coming and telling that I would like to execute it immediately, early settlement, early execution, before due date execution. Okay. So the 9 situations you have understood. Okay. In this 9 situation, a few points you have to keep it in mind. First thing, after due date, it is compulsory cancellation. After the due date, it is compulsory cancellation. Means if customer comes late, he does not come on time, first thing, cancel the contract. If he wants to execute, if you want to cancel, if you want to extend, that will handle separately. First of all, he came late, compulsory cancellation. Okay, first cancellation will happen at the first. So what process we have to do? We should do that. We are going to learn. Anyway, this is also called as overdue contract. After the due date is over, so it's called as overdue contract. First thing, cancellation. Then you want to execute, then this will be a fresh transaction or new transaction. And you want to extend, this will be also a new transaction. Even in case of extension, see, on the due date extension or before the due date extension. So if you want to extend first, you'll always cancel first and then extension. So what point to be kept in mind? If it is extension, it will always be cancellation. Happens, understood, implied, plus the fresh transaction, new transaction, new contract for new due date. That's one principle, keep it in mind. Extension, first you cancel, then we'll extend. So if you want to postpone, if you want to roll over, if you want to renew, whatever name you give, first you cancel whatever happened and then you start fresh. You sign a new contract. And similarly, if it is overdue contracts, first thing is compulsory cancellation. If you want to execute, then it will be separate spot transaction. If you want to extend the contract, separate forward transaction, but that will be separate. First you cancel plus new contract plus new transaction, new contract, new transaction for either for settlements, either for execution or for extension. Okay, so extension, first cancellation, then you enter into fresh contract for new due date. Overdue contract means it is compulsory cancellation plus new transaction for execution or extension. So ultimately now, how many situations we have to understand, especially 9 situations I told you, but we need not discuss all 9 situations now. Why? Because cancellation will have always have automatic extension. So I need not discuss these two separately. Extension, I need not discuss with you. It's automatic. I mean, in the sense, you enter into a separate transaction. So only we have to understand cancellation. That will come automatically in extension as well, because it will be a separate contract. Okay. Now, on due date execution, I did not discuss. Why on due date execution I did not discussed? Because that is normal, right? That is, everything happened according to expectation, nothing new. So I don't have to discuss on due date what will happen. And after due date execution, I did not discuss because it's compulsory cancellation. I just told you. Effectively, how many situations we should discuss, how many type of problem we have to understand. Transaction is on due date cancellation, before due date cancellation, after due date cancellation, and before due date execution. Broadly, if you understand these four, everything else is a fresh transaction. Anyway, uh, we discussed all the 9 situations, but I just told you, typically, effectively, you will get 4 situations. Okay, so this is one uh, point to be kept in mind, or like 2 points. Overdue contract is compulsory cancellation, and you will have 3 types of charges you will get. I will discuss one by one little later. First, you can write down 3 types of charges you will get. One type is called as exchange or charges, or exchange difference. One is called as exchange difference, and then swap charges, and then interest on delay. Interest on delay. Outlay. Okay. Interest on outlay. Interest on outlay. Interest on outlay. Exchange difference, swap charges, interest on outlay. Again, how exactly to compute, I'll tell you a little bit later, but I'll tell you a quick concept around it. Exchange difference is used for cancellations. Exchange difference is used for cancellation. So wherever cancellation comes, exchange difference comes. Wherever cancellation comes, exchange difference comes. How to calculate? We'll come to it later. Basic principle to remember, a square of concept. Sir, what is square of concept? First I do future sell, then I do future buy. Or first I do future buy, then I do future sell. They will set off each other. That is like cancellation. That is what? Exchange difference. Like square of. Not exactly square of. Square of will come in futures. But like that. The difference between the rate on buying and the rate on selling. That is called as exchange difference. Name itself will tell exchange difference between buy and sell. Okay. How to calculate? When it will come? We'll discuss later. So used for cancellations. Now swap charges is for, it will come during renewals, extensions. Okay, it will come during renewals. Forward renewals by bank. Forward renewals by bank. What is a renewal? I'll come to it. When it will come, I'll discuss in the which situation. Just understand. So what you understand? You will have a insurance policy, health insurance for this year. Now this gets completed. Next year, what do? You enter into one more transaction. You enter into same transaction. You renew, right? How you understand what is the meaning of renewal? You keep doing it again and again, not extension. Huh? This is this expired. You start fresh. The contract which you had got expired, so you start fresh. Understood the point? For renewals, that's called as swap charges. Interest on outlay will happen. Interest on outlay will happen when cash flow takes place different from due date. This will happen when cash flow different from, or cash flow on date different from cash flow on dates different from due date. Cash flow on due date different from due date. So due date cash flow taking place either below or after. So the bank is incurring opportunity cost. Bank is incurring opportunity cost. That is what he will collect from customer. Cash flow taking place on a due date, on a date different from due date. So on the difference, opportunity cost, you can also remember this like an opportunity cost. Opportunity cost. Okay. Fourth point. Okay, this is one area where people get confused. Just understand. Again, I'll try to try a diagram. Hope you'll be able to understand. Bank. Please think from bank point of view. Okay. Please think from bank point of view. Between bank and interbank, and between bank and customer. Okay. Now, between bank and customer, here what you have to understand is bank's profits is customer loss for customer, or profit for bank. Here, between bank and customer, profit for bank is loss for customer. And loss for bank is profit for customer. Correct? One person profit, other person's loss. This is between the transaction between bank and customer. Profit for the bank is loss for the customer, and loss for the bank is profit for the customer. Okay. Now, sometimes because customer request, I would like to cancel, or customer says I want early settlement, or customer says overdue execution. So due to customer request, listen to me carefully, due to customer request, bank does some transactions in the interbank. Now customer says I want now itself. What will bank tell? Okay, wait, I'll go to interbank and get it for you. Due to customer request, bank does some transaction in the interbank. Due to customer request, suppose bank incur loss. Due to customer request, bank does some transaction and bank incur loss. Loss for bank. Okay, now can you please tell me? Think logically. Think from bank point of view and try to tell me the answer. Customer came and requested something. What is something we'll discuss later. Customer came to bank. I wanted something. Bank said, okay, I will help you. And bank incurred loss of 1000 rupees. Logically tell me, what will bank do with respect to that loss? Bank incurred that loss because of customer request. So logically, don't you think bank will recover that from customer? Correct? So loss for the bank is loss for the customer. They will pass on. Loss for the bank is loss for customer. And similarly, profit for the bank is profit for the customer. That is why I told you it's very important. Is the transaction between bank and interbank, or transaction between bank and customer. If transaction between bank and customer, then profit for the bank is loss for the customer and vice versa. But if the profit or loss happening to bank due to request of customer, because of the request made by customer, bank will not incur that loss, bank will recover from customer. So you please remember this, like this loss will be recovered from customer, recovered from customer. I hope you understood this fourth point. The between bank and customer, one person's profit is other person's loss, but between bank and interbank, because of customer request, if bank incur loss, because of customer request, special request, if bank incur loss, they will recover from customer. So loss for the bank will become loss for customer and vice versa. Okay, this is what I just telling you. This chart, you don't have to take it down, just to make things more clear. For the bank, with the customer, if bank makes profit, bank's profit is loss for the customer. Customer has to pay. If bank make loss, bank's loss is customer profit payable to customer. With the interbank, if bank makes profit, bank's profit is customer profit. Bank should pass the profits, passing the profit to customer. Bank made profit because of customer request, it's belonging to him. You give it to him. If banks makes loss, that is with the interbank, that loss now is loss for the customer. I have to recover from customer. Again, this is the principle to be kept in mind while doing the transactions on these 9 situations. Okay, so I hope you got all these points. Now let's look at one by one. This is what we discussed. This chart we'll discuss, but I'll do a little bit later. You'll get a clarity once we discuss the. Okay, this summary will come to it little later. Okay, now let me go for one by one situation. This chart we'll discuss little later. We'll discuss. Okay, let me discuss one by one situation and let's see what are the transactions or the situations involved. Okay, now on due date. Okay, first let's say date of entry into contracts. Date of entry. Let's say example 1/1/2022 and due date is 3 months. Let's say means due date will be 31st of March 2022. On due date, you say you will execute. Okay, let's say the original contract was forward buy. Original contracts or contract was for, agreement was for, the agreement was forward buy. Okay, or let me do one thing. Okay, let me do one thing. Let me give a transaction from bank point of view. You'll understand better. So that the same format we can solve in all the problems. Okay, now think from bank point of view. Okay, I'm very clear. I'm explaining from bank point of view. Date of sign contract. Date of signing. Let's say that is on 1st of Jan 2022 and 3 months contract. So due date will be 31st of March 2022 and you will sign an agreement with the customer. So you will have a transaction with customer, and you will enter into, you'll agree for a forward rate. Let's say you agree for forward buy. You'll agree for forward buy with customer. And the rate, forward rate, at the rates, at forward rate. For example, let's say $1 equal to 70 rupees. Now, can you please tell me, with the customer you are entering for fewer forward buy, what will they do? Corresponding transaction in the interbank market. With interbank market, what will they do? They have to cover their position. They are going to do opposite. So they will agree for forward sell. Correct. At what rate? Uh, at rate maybe 69 rupees or 68 rupees. At cover rate, it's called as cover rate. It's also forward rate for them, but we call it as cover rate. Let's say $1 equals 68 rupees. Means 2 rupees their margin, 2 rupees their profit. No, they sell it at 72 rupees. So they buy from the customer at 70, sell it in interbank at 72, they make a profit of 72. So on due date, if execution happens, that means everything happened accordingly. Execution, yes, you execute. That means you buy from the customer at 70 rupees and sell in the interbank market 72, and thereby you make a profit of 2 rupees. This is everything is executed. Now, if it is cancellation, customer would like to cancel. Okay, if execution. If customer would like to cancel. Okay, if customer would like to cancel. Now, imagine the bank situation now. What was bank thinking? I will buy from customer, sell it in the interbank market. Now bank says no. Now banks from the customer says I don't want to settle this transaction. I would like to cancel. Now think from bank point of view. A dollar was supposed to come from customer. Now that inflow stopped. But this, you can't cancel the contract. You have to go to interbank market and sell it. Now can you please tell me, what should bank do to fulfill the transaction? Now this buying is not happening. Are you understanding? This buying was supposed to happen from customer is not happening. I'll explain the position once more. Think from bank point of view. I was supposed to get it from customer and sell it in the interbank market. This sell in interbank market already agreed. With the customer already agreed. But now the customer says cancel. So what dollar was supposed to come from customer is not coming. But your obligation to sell is still there. Your obligation to sell still there, which means what you should do? You are not buying from customer. Instead, you will buy from interbank market. I hope you are able to understand. So you have to buy from interbank market. Customer bank point of view is not buying from the customer. You buy at spot rate from interbank market. Buy at spot rate from interbank market and then sell it. And then sell it at whatever rate. Sell 72 only. So, let's say the market rate happened to be 70.5. In the market rate happened to be 70.5. Buy at spot rate at 70.5. And you are selling at 72. So, how much profit you are making now? 72, instead of 70, you are buying at 70.5 and selling at 72, you're making a profit of 1.5. Now, what is the differential profit you're making? Because customer cancel, you are having a differential profit of 0.5. Now that 0.5 you will recover from customer. Did you get the process? The bank was supposed to buy from customer and sell it in the interbank market. Now the customer refused, therefore bank is buying from the spot market and fulfilling their obligation. And they were supposed to make a profit of 2 rupees. Now they make a profit of 1.5. So the shortfall profit is there, 0.5 will be recovered from customer. This will be recovered from customer. And what is other way of understanding? What is this 0.5? That is difference between these two rates, right? The forward rates, agreed, and the spot rates. That is the difference what he has to pay. That is a 0.5 difference. This is called as exchange difference. This is called as the exchange difference. Exchange difference between the original forward rate and the spot rate. If you think from bank point of view, it is buy. If you think from customer point of view, it is sell. I hope you understood the whole process. So you can see ultimately cover rate did not have any impact. I showed you, but ultimately difference is due to the cancellation rate and the original forward rates. Cancellation rate and original forward rate. I'll give a summary with respect to uh, bank point of view. How would you think? With respect to customer point of view, how would you think? But before that, I hope you understood this process. And of course, extension, I need not talk about it. If it is extension, first we'll have cancellation and then you will have new contracts. So extension we will not discuss separately. Extension will be, it will be cancellation plus new contract. Whatever the new rate they will give. I'll give a summary of this, but before that, I hope you understood the process. Okay, let me give a summary of this. Okay. Fine. Okay. Now, so what is the situation now? This is on due date cancellation. On due date cancellation. This is the situation we are discussing. And only charges that applies exchange charge, exchange difference. Only difference that applies is exchange difference. Okay. Now I will tell you how to think from uh, the customer point of view. You can also think from the bank point of view. I just explained bank point of view. Now the easy thing is to think from customer point of view. So I'll tell you exchange difference. I'll just give you from customer point of view calculation. Customer point of view calculation. Exchange difference. This will be basically difference between whatever the original forward rate minus opposites spot rate, opposite spot rate. If buy was earlier, now sell, so that it is cancelled. Opposite spot rate on due date. Opposite spot rate on due date. So if you think from a importer point of view, or you can think from a exporter point of view. For importer point of view, it will be difference between customer point of view. I'm telling original. What is the original rate? Original rate is forward buy, and now it will be spot sell rates minus original forward buy rate. Original forward buy, FB, forward buy. Spot sell rates, original forward buy rate. That is the exchange difference. And for exporter, it will be original forward sell rate, FS, forward sell rate, minus, now it will be spot buy rate. That is a profit. If it's positive, profit for the customer. If it is loss, loss for the customer, minus. And when you're taking spot sell rate, you should take a lower amount. Original forward sell rate, you have to take a uh, spot buy rate, you should take a higher rate. Because customer's advantage disadvantage position, or now bank is transacted with the interbank. So bank is also at a disadvantage position. Either way you can think, that's how you calculate. From customer point of view, the situation of on due date cancellation. On due date extension, I did not tell you. Extension is very simple, cancellation plus new. Cancellation is what you have to understand. Okay, I hope you have taken it down. This is from customer point of view on due date cancellation. So on due date execution is normal situation. On due date cancellation we have discussed. On due date extension is cancellation plus new. So three situations are completed. On due date situations are completed. Now I'll go for after the due date situation. After the due date. Okay, now after due date, how it will happen? Let me discuss. Sorry, before due date. After due date, I'll come to later. Before due dates, execution will come to later. I'll say before due date cancellation. Before due date cancellation means what and how will happen. Think from bank point of view to understand the process. Bank point of view. Bank point of view. Okay, now with customer, always remember two parallel transactions and with interbank. Let's say with the customer, the bank is entered into on 1/1/2022. The bank is entered into a forward buy. Sign again, a date of entering. This is date of agreement. Date of agreement or date of signing. 1/1/22. Let's say forward buy with the customer at the rate of, let's say, 72. And with the interbank, what will they enter into? Enter into forward buy. This is forward rate. With the interbank, what will they enter into? Opposite contract. They will be doing forward sell. enter into forward sell at, let's say, 73, and that is going to be cover rate. This is forward rate and this will be cover rate. Okay, now our due date, let's say 3 months contract, so 31st of March 2022. If execution happens, already told you what will happen. Again I explained, but I'll do it once more. If execution happens, then what will you do? You will actually execute. You will buy at 72 and sell at 73 in the market, interbank market, as per agreement, and you make a profit of 1 rupee. This is intentional, original. But before the due date only, customer and comes and tells before due date. Let's say on 28th Feb 2022. Before due date, customer comes and says, I will cancel. I am not going to execute on due date. I am telling you in advance. Cancel in advance. Cancellation. On 20th February itself is telling you cancel. Okay. Now, again, customer, think from bank point of view, what bank was supposed to buy from the market now got cancelled. I mean, what the bank was supposed to buy from the customer. Understanding the process, bank was supposed to get from customer and sell it in the interbank market. Now customer is not giving. So what should bank do? Same situation as earlier. Think from bank point of view. Bank was supposed to get from dollar and give it to the cover rate, interbank. Now the bank is not able to receive from customer because customer cancelled. So what should bank do? Bank should get it from interbank markets. You're not able to buy it, you're not able to buy from customer, so you're going to buy from interbank market. Buy from interbank market. Buy from interbank market. At, let's say, 72.6. Buy from interbank market at 72.6. Okay. And you sell at 73. And therefore you make a profit of 0.4. And differential profit is 0.6, and that differential 0.6 is due to 72 and 72.6, which is 0.6 difference. So effectively, difference is between the buy rates for the bank. Effectively, that is the difference. So profit reduced, again, this will be recovered from customer. Recovered from customer. So if you think from customer point of view, he is selling at 72 earlier, now he will be buying at 72.6, buying at higher rate, so it's going to make a loss. So loss for the customer is profit for the bank, and that's what bank is going to receive from customer. Anyway, what is the important point? Please look at the important point. He is coming and telling on 28th Feb I will cancel. But you don't have to buy on 28th Feb. You have to buy on 31st of March. He is informing you 1 month in advance. Which means this 72.5, 72.6, you are not buying in spot market. You are buying in forward market. This is buying in forward market. I hope you are able to understand the situation of the banker. Banker, after 1 month, his obligation is there. After 1 month, remaining 1 month, you were supposed to buy from customer. Now customer is not coming. So you do an alternative. What alternative? You enter into a forward contract due after 1 month, so that both will fall on the same due date. The original forward forward contract due after 3 months, and the new forward buy contract due after 1 month remaining. Ultimately, both will come on the same date, and you can buy using this contract and sell it here, and you can fulfill your obligation. And therefore, this difference of 0.6, that you have to buy from customer is not recoverable today. This is recoverable on due date only. Recoverable on due date. But in future, what used to happen? Very similar. But in future, there was concept of mark to market. Every day settlement used to happen. So this money would have come to your account by now. But in forward market, no MTM concept. So you have to wait till due date for the customer to receive or for the bank to receive. I hope you understood before the due date cancellation. So, okay, I'll do a summary just like I did for this customer point of view for on due date cancellation. Now I'll do summary for customer point of view for after due date transaction. Customer point of view. After due date cancellation. Sorry, before due date cancellation. Before due date cancellation. Again, only one thing will come, that is exchange difference. And how do you calculate? It is a difference between original forward rates, minus new forward rates. New forward rate on the date of cancellation. New forward rate, of course, both of them will due on due date. Both of them will be settled on due date. New forward rate. What was this here? Remember, for opposite spot rate, right? In this case of cancellation on due date, original forward rate and opposite spot rate, because you're cancelling immediately. But here it will be opposite new forward rate. Why forward rate? Because you're cancelling 1 month in advance. So this is for, again, exporter and importer. If it is an exporter problem, if you are an exporter customer, what would be your original transaction? Okay, first I have written importer earlier. Importer and exporter. Originally you would have entered into forward buy. Now it will be forward sell. Forward sell. Okay, new forward sell. This is new rate. New forward sell minus original forward buy. Thinking from customer point of view. Original forward buy. And new forward sell will be at a lower rate because customer is on disadvantage position, or even bank is disadvantaged because bank is going to the interbank. Uh, Import exporter point of view, original, it will be forward sell. So original forward sell minus new forward buy. Buy and sell opposite, opposite. That's what I told you, opposite. But opposite will be new contract, and new forward buy will be at a higher rate because bank is disadvantaged or even customer is disadvantaged, buying at a higher rate. Okay, and extension I need not discuss with you. As I told you, extension will be cancellation plus extension. That is plus new transaction, new contract. Okay, now here we come one important part, that is before due date execution, early settlement, before due dates execution before due date, or you can say early settlement, cesarean, you can say early settlement, early delivery, early settlement. Now, first of all, should the bank oblige? If the due date is on 31st of March, if customer comes on 20th and say, I would like to execute, should the bank oblige? Legally, they need not, but they will, because they have to support the exporter importer transaction. Even government has suggested them. So usually, if customer goes earlier, early settlement, the bank will oblige. So from exam point of view also, you should take it as bank will oblige. If bank does not oblige, the discussion only will not happen. It will be only either execution on due date or cancellation due date. So early settlement, we always assume the bank will oblige. So situations, same thing. Think from bank point of view. This must be from bank point of view. This cannot be from customer point of view. This must be from bank point of view, compulsorily. Bank point of view. With interbank, with customer, and with interbank. Okay. Date of signing on, let's say, 31st of 1st of January, date of signing, 1st of Jan 2022, 3 months contract. With the customers, let's say you have entered into forward sell, let's say, this time I'll say little bit different, forward sell. Enter into forward sell, let's say at 72, and here you'll go for enter into forward buy, let's say at 70 rupees. So this 72 is what original forward rate, a 70 is called as cover rate. If everything happens according to expectation, due date on 31st of March 2022, let's say 3 months contract, you sell to the customer at 72 and buy from the interbank market at 70, and you make a profit of 2 rupees. Okay, now what the customer is telling, please listen to me carefully. Before due date, customer is coming and asking on 28th of Feb 2022, I want delivery, early delivery, and you have to honor it original rate only. The bank will not say, no, this was original forward rate, this today rate will be different. You will honor at original rate, and for that, any charges that happens, extra charges, you can collect from the customer. So before the due date, customer is telling and say, I want early delivery, requesting for early delivery, requesting for early delivery at original rate only, at original forward rate. Now, I'm not sure whether you can think the bank position. Bank, what was the bank original intention? I will buy from the interbank market and then give it to customer. That was your plan. Buy from the interbank market and give it to customer. And then now the customer is telling I want early only. So what should bank do? Can you think and tell me? On 31st of March, your plan was buy from the interbank market, give it to customer. Now customer is coming early and telling I want. So as a banker, what will you do? The due date has not yet come. So you're not able to buy at the cover rate. What bank should do now? On 20th of February, customer is coming, sitting on your table and say, I want it. Bank cannot say come after 1 month. Bank somehow has to fulfill his requirement. What do you think bank should do? Customer is sitting in front of you on 20th of Feb. Bank don't have dollar. Okay, so what they do? They should buy from the spot market, right? That's what they are going to do in the interbank market or whatever it is. They buy, or let's say I write it here from the interbank. They buy at spot rates. They buy at spot rates. Let's say spot rate happened to be 70.5. They buy at spot rate at 70.5 and sell it to the customer at 72. At original rate only they have to honor. So buy from the markets in the interbank market and sell it to the customer at original rate. Yes, you make a profit. But there is one problem. What is that? This contract is still due, right? This contract is still due. You have to buy from the interbank market. Was supposed to sell it to the customer. Now the customer is not there. You still have to sell. To whom will you sell? You will sell in the spot market on 31st of March. But today you will fix it. So what do? You enter into a forward contract. Forward sell. You'll enter into a forward sell. I'll repeat this once more. The banker was buying from the forward market, selling it to the customer. Now customer came early, so you buy from the spot market and fulfill customer request. But this cover transaction is still open now. Customer is not there, so instead of selling in the customer, you will sell in the interbank market. That is what is going to be forward sell. Forward sell. On 28th of February, you will enter a forward sell so that you can fulfill this contracts. You can fulfill the obligation which you created. That is open now. That can be fulfilled. Forward sell at, let's say, whatever rate, at the rate of 69.5 or whatever it is. So 69.5. Whatever the rate, forward sell rate on this date. Now this difference, you are buying in the spot and selling in the forward. This difference is called as swap difference. Swap charges, swap difference. And this difference, sell at 72, cash flow taking place earlier to due date, and you buy at 70.5, cash flow taking place earlier to due date. This one, that is a difference between the cash flow, what is taking place. On this, you are going to charge interest. This is outlay, interest on outlay. Interest on outlay. Why? Because there are two cash flows taking place before due date. You are selling before due date, you are buying before due date. These are cash transactions. So whenever cash outlay happens before the due date, on that you are going to have interest on outlay. So swap difference will come Interest and outlay will come. Cancellation charges will not come. And why cancellation charges will not come? Because the contract is not cancelled here. The cancellation charges, exchange difference comes only if the contract is cancelled. Contract is not cancelled here. So here the exchange difference do not come. You have swap difference because you are creating one more forward contract. You have interest and outlay because cash flow taking place before due date. If you just want to compare what is this exactly is going to be. Okay, so what is this profit or loss for you now? You are selling at 72 and you are buying at 70.5. So here you get profit of 1.5, and here you are buying at 70 and selling at 69.5. So you will have a loss of 0.5. So effectively you are getting a profit of 1 rupee. What is that profit of 1 rupee is all about? That's what is swap difference. 69.5 and 70.5. Same profit of 1 rupee. The difference profit you have to recover from customer, receive from customer. Or profit was earlier 2 rupee. Now the profit is 1 rupee. So difference is 1 rupee loss. And what is that 1 rupee loss? Is a swap difference. And this profit of 1.5 you are getting before due date. So you are supposed to get after due date, but you're getting before due date. So on this, you will have opportunity cost. You made interest income, of course, that will be passed on to customer. Okay, now this has to be thought from bank point of view. Okay, let me give a summary of this one. This has to be from bank point of view. This cannot be from customer point of view. So bank point of view only. This cannot be from customer point of view. So this is early settlement, early delivery. Early delivery, that is before the due date delivery. You will have two kinds of charges. You have two kinds of charges. One is swap difference and other is interest on outlay. Swap difference and interest on outlay. Now swap difference is calculated by uh, okay. Swap difference is calculated by, that is spot buy rate, in the sense for export import I will tell you separately. It is on the before due date, or what is the spot sell rate or whatever spot rate minus opposite forward rate, new rate, opposite forward rate. Interest and outlay will be the original forward rate, minus spot rate, this rate minus spot rate. On this, you have to apply the rate of interest into percentage, and for how many days? For time till due date. For time till due date. Like in our example, for 1 month. 1 month early, you executed. So for 1 month, you have to calculate interest and outlay. So I'll explain both of them. From if it was a exporter transaction or the importer transaction. Let's say importer, if it is an exporter transaction. Okay, think from bank point of view. Okay. Both charges I will calculate. Swap charges and interest on outlay. For exporter also, I'll tell you same thing, how to calculate swap charges and interest on outlay. Okay. Now let's think from importer point of view. Now, can you please tell me what transaction importer would have entered into? Forward buy or forward sell? What transaction importer would have entered into with the bank? Importer would have entered into forward buy. But I'm thinking from customer point, a bank point of view now. So bank would have entered into opposite, of course. For a customer, it is buy means. For a bank, it is sell. So bank would have entered into forward sell. But for that forward sell, the bank has to do immediate purchase. That is what it is going to be spot buy and forward sell. So it is going to be forward sell minus spot buy. Forward sell, original forward sell. You can tell sorry, the new. These both are new. A new forward sell, not original. New forward sell minus spot buy will be at a higher rate. They are basically renewing. You are buying and selling. And interest and outlay will be the original whatever is the forward sell rate. Original forward sell rates minus the spot buy rate. The cash flow taking place. On this, of course, you have to apply the percentage and number of days term by 365, remaining term. Swap charges for exporter, what transaction the exporter would have entered into? Forward sell. So the bank would have entered into forward buy. So they will be doing new forward buy now. New forward buy minus spot sell. Uh, yeah, new forward buy minus spot sell. Sell will be at a lower rate. And interest and outlay, the cash flow taking place today, you are buying from the customer, original forward buy and spot sell. Oh, this should be reverse. Sorry, spot sell minus forward buy. I mean, this is okay, but it has to be reverse. Spot sell, this will be reverse. I mean, the plus minus only will come. So it will be spot sell, sell minus buy. That's why spot sell, which is lower rate minus new forward buy. New forward buy. Of course, it will be at a higher rate. Interest and outlay, uh, spot sell minus original forward buy. Of course, the spot sell, that will be at a lower rate already identified. That will be anywhere at a lower rate. Again, this is the difference. On this, you have to apply the percentage, apply the term T by 365 into the percentage into T by 365. Just take the previous one into T by 365. Okay, so this is regarding the bank point of view. You have to solve only from bank point of view. This early delivery cannot be solved from customer point of view. Okay, and so we discussed three situations in on the due date, and we discussed the three situations in the before due date. Before due date extension, I did not tell you. It is cancellation plus new contract. So extension is automatic. Now we'll come to one more very important area, that is overdue contracts. Overdue contract. What will happen? So let's come to that. This also must be from bank point of view. Overdue contracts. Overdue, that is after the due date. Overdue contracts. Again, it has to be from bank point of view. Okay. So date of signing, let's say on 1st of Jan 2022, and due date 31st of March 2022, and now cancellation date will be different. Cancellation date where customer actually walks in, let's say he will come on 10th of April 2022. Overdue cancellation date. In fact, as per FEDI, Foreign Exchange Dealer Association of India, FEDI, the contract will automatically cancelled if customer does not come within 15 days. But those things and all, you don't worry. In the exam, they'll tell you cancellation date. We'll take that. Let's say we'll say import transaction. Import means bank would have entered into initially forward sell, enter into forward sell. This is with customer, and with interbank. Okay, it will be for enter into forward buy. Okay, on the due date, customer did not come. So you still have to execute this, because cover transaction you can't say no. So you have to execute at whatever original cover rate. Execute by at whatever the cover rate, original cover rate, original cover rate. Okay. Uh, I'm not sure whether you can answer this question. Try to answer. What was our original intention? I buy from the market, give it to customer. I buy from the market as per the cover transaction, give it to customer. Now customer did not come on the due date, but you have to buy. Dollar is with you now because you have to honor your commitment. You have bought as per the cover rate. Now dollar is with you now. You are supposed to give it to customer. Customer is not there. So what do you do with that one? You are supposed to give it to customer. Customer is not there. So what do you do with what you have? You will sell it immediately. Means you have to sell in the spot market. This one was supposed to be given to customer. Customer did not come. He did not come. So what do you do? This he did not come. So what do? You are going to sell in the spot market. Sell in the spot market. On due date, you sell in the spot market on due date. Okay, now in case customer comes, you should be ready with it. That is, you can't say, no, no, you did not come, I cancelled it. In case customer comes, you should be ready with it. You may not give it to him, but you should be ready with it. So what do? You are going to enter into forward buy contract. That is, in case customer comes, this sell spot is to complete this honor, to complete this cover transaction. Cover transaction, and you close the cover transaction. For that, you sell spot. But if customer comes again, you should be ready with it. So you enter into forward buy. So basically, you're renewing your position, and this is the difference between the forward buy and spot sell. This is what is called as swap. This difference is called as swap. Okay. Now then customer comes. Customer comes, and now you have to cancel it. So what transactions you would do? Earlier you enter into forward sell with the earlier you did a forward sell with the customer. Now on cancellation on 10th of April, you are going to do spot buy. Earlier forward sell, now you do spots buy with customer. So this will be called as exchange difference. Exchange difference. And here cash flow also taking place, because you are executing at original cover rate and you are selling in the spot rate. This difference what you have, this difference what you have, cash flow taking place on the due date till the cancellation date, you have to charge interest on outlay. So this is the only situation where all the three things will come. Exchange difference will come, the swap difference will come, interest and outlay also will come. Exchange difference to cancel the original contract. Swap difference because in case customer comes, you should be ready with your position. Interest and outlay because you are incurring out of your pocket cost for these 2 days from the due date till the cancellation date. And in some RTP problem, the due date they've taken plus 2 days. It's like 2T plus 2 problem and all. Anyway, that will sit in the problem. But all the three kinds of transactions will apply on overdue date. So exchange difference takes place on cancellation date for cancellation purpose. Swap difference for the purpose of being ready in case customer comes. And interest and outlay, that is difference between the transaction taking place on the due date until the cancellation date. And one very interesting point, if you get a profit for the bank, they were supposed to pass it on to customer, right? So this swap and this interest on outlay, the swap and interest on outlay, if profits will not be passed down to customer, if profit will not be passed on to customer. Whereas in early settlement, early date, the due date transaction, if profit comes, passed on to customer, loss from comes record from customer. But in this case, it's an overdue contract. So even if you cancel, this will not be passed on to customer. And for this solving the problem on overdue contract, I have a very good shortcut, but I will not explain now. I'll explain when I do problems. It's a very good shortcut there. But this process is to understand the overall summary and the transaction. And one more point, in cancellation, I told you in overdue contract, cancellation is a must. If the customer wants execution, then you are going to do a separate spot transaction. If customer wants extension, you are going to do a separate forward transaction. So cancellation is what you have to understand in overdue contract. Execution will be a separate spot transaction. Extension will be a separate forward transaction. So three kinds of charges that you have to apply. Okay, let's do summary on this. Three kinds of charges from bank point of view only. If it is if it is for import transaction, how do you calculate? If it is for export transaction, how do you calculate? Three kinds of charges will come. So let me originally banker has entered into forward sell with the customer. Now that forward sell contract should be cancelled. And how do you cancel that forward contract? You will enter into spot buy transaction with the customer. Because earlier was sell, now you do buy, so that in effect the contract is cancelled. You are not executing that contract. That is why. And spot buy because you are cancelling immediately. So spot rate. And why buy rate? Opposite of sell rate. No, this will not be any actual spot buy will not happen. This is a difference. That's why I told you exchange difference. So the sale will not take place. This buy also will not take place. But the difference will be paid or receipts. If it is profit or loss, depending on that. So that's why it is only exchange difference. Actual transaction is not taking place. Okay, so let me try to summarize. Overdue contracts from bank point of view. Cancellation, overdue contract cancellation, compulsory cancellation. So three kinds of charges will come. So I'll say charges. I'll discuss individually, or how do I write it? Mm, okay, fine. So charges. First, let me give you logically. Three types of charges are there. One is exchange difference. Then swap difference or swap charges, and then interest on outlay. Okay. Then I'll go for the two positions. Mostly from exam point of view, it will be importer transaction or exporter transaction. Import export is only for your reference, but it is calculated from bank point of view only. You cannot avoid. And this is the only place where cover rate is going to play a role. In other places, cover rate did not have any effects. Okay, so exchange difference will be original forward rates minus, this plus or minus will happen. So conceptually, original forward rate minus opposites spot rate, opposite spot on cancellation date. On cancellation date. Okay, swap difference. Uh, it will be on the spot rate. So it will be spot rates on due date. This is to fulfill the cover transaction. Then renewal, that will be minus new forward rate on due date. on due date. Interest and outlay, the cash flow taking place, which is the cover rate minus the spot rate on due date. This one, same thing. Multiply by the percentage and multiplied by number of days by 365. Number of days is from due date till due cancellation date. The T will be from due date till cancellation date. Till cancellation date. Okay. Importer transaction, three kinds. Exchange difference, swap difference, interest and outlay, exchange difference. Okay. Is a difference between original forward rate. Importer would have forward buy, but I'm telling you banker would have done forward sell. So exchange difference will be original forward rate sell. Original forward rate sell minus spot buy. Spot buy on cancellation date. On cancellation date. And let me tell you, this will be lower rate. It's a very interesting situation. It's very important. Lower rate. Why it is lower rate? Because bank is transacting with the customer, and bank is transacting with the customer means it will be at advantage position. So they will buy at a lower rate. Spot buy on cancellation at lower rate because bank is on advantage position. And one more thing, keep it in mind, only when the transaction is between bank and customer, there is going to be margin also, but the transaction with the interbank, margin will not apply. We discussed in the basics only. Anyway, I just told you for your revision purpose. Okay, so this is the exchange difference. Swap difference is, so what is going to be the swap difference? First transaction, you are supposed to sell it to the customer. You are supposed to sell it to the customer. You are not selling it to customer. You are selling in the spot market. So spot sell on due date. And this spot sell, you are selling in the interbank market. So it's going to be a sell at a lower rate. The bank, when they're transacting with interbank, will be on a disadvantage position, will be at a lower rate. So spot sell on due dates minus to renew your position, that's going to be forward buy on due dates, and this is going to be again higher rate because bank is transacting with the interbank on a disadvantage position at a higher rate. So spot sell rate on due dates minus forward buy on due date. Okay, interest and outlay, the transaction taking place, the cash flow taking place. What cash flow taking place? A spot sell and cover rate buy, I think. Yes, cover rate buy, right? Yeah, cover rate buy. So forward sell rate, this is spot sell rate, cash flow taking place, spot sell on due date. I'll write DD, hope you understand. Spot sell rate on due, I will write full form what it is. Spot sell rate on due date minus the spot, the cover rate buy, the transaction which is executing, cover rate buy, original cover rate buy. Now this you multiplied by the percentage and multiplied by t by 365. What is t? Already told you. In the exam problem, so far any question I have come, it is from importer point of view only. But anyway, I'll give you for exporter point of view also, exporter problem also. Three charges will come. Or I'll write like this. Hope you understand. Let's play it vertically. Exchange difference. Same three. Swap difference. And interest on outlay. Okay, exchange difference will be what the original transaction would be. Original would have been forward buy. The exporter will give it to the bank, so bank will buy. So original transaction will be forward buy, and the spot opposite contract will be spot sell on cancellation date. So exchange difference will be spot sell on cancellation date minus original forward buy. Original forward rate buy. Original forward rate buy. Bank would have purchased from customer. Customer would have given to bank. Bank would have purchased. Now cancel, spot sell, and spot sell will be a higher rate because bank is on advantage position. This will be on higher rate. Swap difference. Swap difference on the cancel on the due date. On the due date, what was supposed to happen? You are supposed to buy from the customer. Instead of buying from the customer, you buy from the market. Spot buy. So it's going to be opposite you do in forward contract. So forward sell on due date, new rate. Forward sell on due date. This is because in case customer comes and gives later, I should be able to sell it to somebody. So forward sell on due date minus spot buy on due date. Instead of buying from customer, we are buying from the market. So forward sell on due date minus spot buy on due date. Spot buy on due date. And this will be, remember, a forward sell will be at a lower rate. Bank is disadvantaged position. This is the transaction taking place in the interbank market. So sell at a lower rates and spot buy will be at a higher rate. Okay. Intention outlay. I don't have space, so I'll write it here. Intention outlay. Cash flow taking place at what rate you are selling. Okay, so from the exporter, you are buying and you are selling in the interbank. Cover rate was set. So interest outlay will be cover rate sell, original cover rate sell minus the spot transaction what you're doing, spot buy, on due date, spot buy on due date. This the same spot buy only, same similar, the same one, spot buy on same date, this one only. And this you multiplied by percentage, you multiplied by t by 365. T, I told you originally only from the due date till the cancellation date. Again, I repeat, in cancellation, in overdue date, cancellation is compulsory. The execution, extension will be a separate transaction. And swap difference and interest outlay, even if profit comes, that will not be passed on to customer in overdue contract. It will be passed on to customer in early settlement. But in overdue contract, even if you get a profit on swap difference, interest and outlay will not be passed on to customer. Okay, let me just give you overview once more now. Okay, uh, okay. What are the terms associated? Try to have a recap of what we discussed so far. Transactions, cancellation. Cancellation means only one thing will come, which is exchange difference, which is difference between original forward rate and corresponding opposite. If you're cancelling on the due date, it will be opposite spot rate. If you're cancelling before due date, it will be opposite forward rate. Logically making sense? I'll explain once more. You have original one rate, let's say original buy. If you're cancelling on the due date, spot sell. If you're cancelling before due date, then forward sell. So both will fall on the same day. Original rate, opposite spot rate or forward rate. If it is cancellation on due date, opposite spot rate. Cancellation before due date means opposite forward rate. That is for cancellation. Extension will be cancellation will happen first plus extension. Overdue contract means compulsory cancellation, and especially on interest and outlay swap difference, profit will not be passed on. And exchange difference, swap difference, interest and outlay, three kind of charges. What is exchange difference? Is used for cancellation purpose. Swap difference is used for two situation. For early cancellation, early delivery it will come. Uh, Not early cancellation, early delivery. Swap difference will come for early delivery. For early delivery, or it will come in the overdue transaction. Swap difference come only in those two situations. And spot rate on the how do you calculate the spot difference? That is original whatever forward contract. Do the opposite and the spot rate. The difference is like a uh, renewal you can say. That is swap difference. And interest and outlay will come in again two situations, that is on for early settlement, early delivery, overdue as opportunity cost, and this is difference between cash flow taking place on the settlement date and the due date. So you can take a quick screenshot of this. I'm going to give one slide summary that will should be a good revision purpose. You can take a quick screenshot of this and you can copy it down later. Okay, next. Now I'm going to give you a full summary. See if you are able to understand this. Again, then I will give the time to take on the screenshot and then you can copy it down. Just understand this process first. Okay, just understand. So first I'll discuss with the export transaction, then I'll talk about the import transaction. Just understand the process. Don't write it down. You can take a screenshot, copy it down later. Everything is from bank point of view. Everything is from bank point of view. Original transaction with the customer. Can you tell me what bank would have entered into? Exporter will give dollar to bank. So what is the transaction from the bank point of view? Bank has to get it. So bank would have entered into forward buy. forward rate. With the cover transaction, interbank opposite, forward sell. That is cover rate, CR, cover rate. Then I'll discuss about import. I told you 9 situation. I'm discussing now all the 9 situation in one place. Okay. If execution on forward rate, execute the forward rate, execute the cover rate, matter is over. Nothing to discuss over there. If you want to cancel before the due date, so what you have done earlier, forward buy. Okay, bank point of view. Earlier, you did a forward buy. Now, what do you do? Opposites. What is the opposite of buy? It will be sell. And why it is spot sell? You're cancelling immediately. You're cancelling immediately. Cancellation is what you're doing, right? Cancellation is what? Cancellation means opposite. Cancellation means opposite. If you're cancelling immediately, then spot rate. If you're cancelling earlier, then it is forward rate. And you are cancelling with whom? You are cancelling with customer. So bank is on advantage position. So they will sell at a higher rate. All these things from bank point of view. And you execute CR. That is not relevant. You can ignore it. Now, this difference is what you call it as exchange difference, or this difference is called exchange difference. This is not relevant. This difference is called as exchange difference. Don't write it down. You can take a screenshot later. Now, extension due date. Extension, that means you cancel first. So, spot sell higher rate, cancel first. And new rate, what is new rate? Same as original contract. What was original contract? Forward buy. Original contract, forward buy. Now, customer wants it again forward buy. FB, again forward buy at a lower rate because bank is on advantage position. Spot sell will happen, means cancellation first and then new thing. New thing will be same as original. And they might enter into one more interbank that may happen. That anyway, that you don't have to worry. Is this first block clear? Take 1 or 2 minutes. See if you have any doubt. H means higher rate, CR means cover rate, FB forward buy, L means lower rate. Okay, now execution before due date, what and all will happen? If it's execution before due date, you have to execute with the bank at the original rate only. So forward buy. What was forward buy? The same thing you execute. Forward buy early. And what do you do with that? You can't keep it with yourself. You go to interbank and sell. You go to interbank, bank is on disadvantage position, you sell at a lower rate. Now, but your cover rate is still in progress. That is forward sale still is there. So you are going to do a forward buy in the interbank market at a higher rate. Sir, how to remember this easily? Very simple. I'll tell you. Focus. Just focus. With customer, what we are doing? We did forward buy. Originally, we are executing early. Now I want this again later. So again buy. Simple, isn't it? I repeat once more. With the customer, we had done forward buy. Now this is executed earlier on due date. Again we want the same thing. Again forward buy. Okay, now we will write this later. Suppose if it is import transaction, can you tell me what will be this? I'm sure you'll be able to tell here. Forward buy, I mean with import transaction, what transactions we will do? With the customer. Customer needs dollar. Bank should give dollar to customer. So bank should give. It's going to be forward sell. Okay, forward sell. Now, what will happen if he wants a early settlement, the same forward sell will happen earlier. Early settlement, early. Okay. Now, can you tell me if forward sell is happening early, what will happen in the spot market on the same date? Forward sell happening early. So what should happen on the spot in the interbank? You have to do forward buy, then you can give it to him. Okay, but this forward sell now got cancelled. You need it again. So what do? You are enter into forward sell. I hope you're able to get the point. Anyway, so what is the shortcut? Whatever is the original contract will be again, but with the interbank market. What is the sentence? Original forward contract will repeat again, but in the interbank market. That's what will happen in swap. What will happen in swap? Whatever is the original transaction, that becomes spot, and the opposite of spot becomes forward. Ultimately, original only becomes forward. So what happens in swap? Whatever happens original, opposite happens in spot, and opposite happens in forward. So opposite of opposite, that becomes original in forward. You forward buy at high rate, and this forward buy, execute it and forward buy. This is what is called as interest and outlay. And the spot sell and forward buy, this is called as swap difference. And if it is cancellation before due date, very simple, cancellation before due date. Earlier with the customer, you did forward buy. Now you are going to do forward sell. Opposite contract. And why higher rate? Bank is transacting with the customer. Bank is an advantage position. So you take a higher rate. Cover rate is executed. Extension will be same as cancellation plus new rate, that is fresh contract, and bank is at advantage position. So bank will buy at a lower rate. Extension after due date. Extension after due date, you do cancellation. So execution after due date. Execution means first cancellation, then spot buy. Why spot buy? Customer wants it. I mean, you are going to give it to customer. Export transaction. You will buy from customer at a lower rate because bank on advantage position. Now cancellation on cancellation after due date. So first of all, cancellation you have to do. What cancellation will happen? Three charges I told you. On the due date, spot buy. What is spot buy? Instead of buying from the customer, you're buying from the market. So spot buy, and you execute CR. That means you sell. For this sell only, you're doing this. To sell in the cover rate, you need buy. Customer did not appear, so you buy from the market. So spot buy. Then reverse forward sell. Basically, you do swap. Forward sell on due date, opposite of these two, called as swap difference, and you're selling at a lower rate because bank is in interbank market. And then you do spot sell on cancellation because earlier you did forward buy. Opposite of that, spot sell, selling at a higher rate, bank on disadvantage position. That's called as exchange difference. And on the whatever the spot buy on due date and execute and forward rate, the execute cover rate, this will also charge interest on outlay. And if it is extension after due date, you cancel first and then fresh buy transaction, and fresh buy will be at a lower rate because the bank is having advantage with customer. This is export transaction, exact opposite import transaction. I will not repeat again. You can ask yourself, exact opposite import transaction. So please take a picture of this and copy it down later. Import transaction I have not explained. I hope you will be able to understand. Broadly, if you have any doubt, you can get it clarified. H means higher rate, FB means future buy, L means lower rate, FS is future sell, a forward sell, DD means due date. Any short form if you're not able to get, CR means cover rate, FB future buy, not Facebook, FS future sell, I mean forward buy, forward sell. Okay, so if you have taken the screenshot, I'll go further. Okay, one more quick summary for you. Again, I'll explain just an overview of it. What kind of charges will come where? See, execution, nothing will come. No charges will come for execution. For cancellation, only exchange difference will come. Swap will not come. Interest on outlay will not come. Because the only cancellation means exchange difference. Extension means also cancellation plus new rate. So swap difference will not come. Interest on outlay will not come. Execution before due date, you are not cancelling execution. So exchange difference will not come. Exchange difference only for cancellation. Swap difference will come. There is a renewal happening. Interest and outlay will come. There is a time gap. If cancellation before due date, only exchange difference. Swap difference will not come. Interest and outlay will not come. Extension before due date, same as cancellation. Execution after due date, all the three will come. So after due date means everything will come. Exchange difference also will come. Swap difference also will come. Interest and outlay will also will come. You can take a quick screenshot of this. Will be a recap later, a day before exam. You can just glance it. It will be useful for revision purpose. Okay, so this is the complete overview of forward contract disposal. Definitely, you have to solve problem and then connect these summary tables and charts. Then the revision can be much easier day before exam. Hope these summary charts also will be useful. So this is the overview of forward contract disposal topic. This question, is it exam question? No, not regular material. Suppose you as a banker enter into forward purchase contract for $50,000 on 5th of March with an export customer for 3 months at a rate of 59.60. On the same day, you covered yourself in the market at 60.6025. However, on 5th May, your customer comes to you and requests for extension of contract on 5th of July. On this date, the quotation for US dollar is as follows: spot 5th June, spot 5th July. Actually, this spot 5th June, spot 5th July are actually forward rate standing today. Assume a margin of 0.1% on buying and selling. Determine extension charges payable by the customer and the new rate quoted for the customer. Round off nearest to the multiple of 0.0025. First of all, let me ask you, this is a problem on extension. Now, extension means, first of all, there has to be cancellation. Now, can you please identify, is this problem cancellation before due date or cancellation on due date? For that, you should look at the dates. You have entered into contract on 5th of March and 3 months is the due date. 3 months means 5th of April, 5th of May, 5th of June. Don't do any grace days and all. 5th of June. And he comes on 5th of May. He comes 1 month earlier and say extension. For extension, first you have to do cancellation. He's coming before the due date. So this is a case of cancellation before due date and extension. Fresh contract. Okay. Just to give you idea, I will write the transaction as per banker point of view, but I'll not solve the problem from banker point of view. I told you only in case of early delivery and in case of overdue contract, it is compulsorily to think from bank point of view. Other situations, it is convenient to think from customer point of view. We can think from bank also, but customer point of view is convenient. But anyway, first I'll explain the process of transactions involved from bank point of view. Then all the calculations I'll do from customer point of view. Just to make you understand the process as they've given the problem, bank point of view. So what transactions you do with the customer, what transactions you do with interbank, then date of signing, then due date. Date of signing. What transactions you have entered with the customer? Banker enter into forward purchase. So enter into forward buy. Entered into forward buy. And for corresponding transactions, you do with the interbank. What is the rate? Forward buy at 59.6. At 59.6. And what will be the cover rate? Opposite. Enter into forward sell at 60.6025. Cover rate. If everything goes well on the due date, you simply execute. But on due date or before due date only customer is coming on, okay, what is date of signing? I don't know what, but 3 months, okay, 5th of March. On 5th of March, date of signing, 5th of March, due date, so 3 months, so 5th of April, May, June, 5th of June, actually 4th of June, but he comes on 5th of May. On 5th of May comes and say request for cancellation. On 5th of May, he requests for cancellation. This is just to make you understand the process. Presentation in the exam, I will not do all these things. I'll show you what you have to present in exam. This is just to make you understand the process. He requests for cancellation. So what do? You cancel. What is that going on your head? It was forward buy with the customer. I have to cancel that contract. So I have to buy from the interbank market. That is one way of thinking. With the customer, I'm not able to buy. I'll have to buy from the interbank market. I'll buy from the interbank market at a higher rate. A bank is disadvantage with the interbank. That is one way of understanding. Other way of understanding is you are going to cancel this opposite contract with the customer forward buy, and this will be forward sell with the customer. So what will happen? This forward buy was due on 5th of June. This forward sell also should be due on 5th of June. So in effect, it gets cancelled. In effect, it gets set off. Now, forward sell, we are entering on 5th of June, due on 5th of July, 1 month later basically. And we are transacting with the customer. Customer will be transacting at a advantage position, at a higher rate. At higher rate, what will be the forward rate on 5th of June, maturing on, on 5th of May, maturing on 5th of June, sell rate with the customer, so it will be higher rate 59.2425. 59.2425. Anyway, this is from bank point of view, just to make you understand the process. But I will not solve the problem like this. I'll straight away go for customer point of view, easy to explain, quick to solve. Customer point of view. It is extension. Extension means first cancellation take place, cancellation before due date, and then we'll have fresh new contract for the new one. Fresh new contract rate. Fresh new contract rate. That is what is called as extension. Cancellation first, then fresh new contract rate. Now, if you want to do cancellation, can you tell me among the three charges, which are the charges applied? Three charges, remember? Exchange difference, swap difference, interest and outlay. For cancellation purpose, which charges applies? It is exchange difference. Exchange difference. The exchange difference comes for cancellation. If you have to do early settlement or late settlement, then swap difference will come, interest and outlay will come. But only cancellation means you have only exchange difference. Now, exchange difference will be difference between whatever the original rate. Now, again, customer point of view. So, you have to think the position clearly. Banker has entered into forward purchase contract. So, what customer would have done? Customer would have done original forward sell contract rights. Banker buy, customer sell. Original forward sell. Minus. Now for cancellation purpose, I should do buy, sell and buy will get set off with each other. Now for buying purpose, is it going to be spot buy? Is it going to be future buy? It is cancellation on due date. Then I'll choose spot buy. But this is cancellation before due date. Before due date. Cancellation before due date. Therefore, it is to be opposite. That means forward buy. Forward buy. And this is customer point of view. Buy. Customers are always disadvantaged position. So forward buy. Customer point of view at a higher rate. And what will you do? With respect to margin, you have taken higher rate. So margin will be even more higher. That means you will add margin. If you had taken lower rate, you would have subtracted. So original forward rate given 59.6, original forward rate 59.6, and the cover rate does not matter here. That's why we could think from customer point of view. 59.60 minus forward by higher rate, which is higher rate on 5th of June, 59.2300, 2425. So 2425, 59.2425 plus margin, margin 0.1%. So how much 0.1%? 59.2425 plus on that 0.1%. 0.0592. 0.0592. So 0.0592 plus 59.2425, 59.3017. Okay, but we have to round it off to the nearest multiple of 25. So last two digits, 17 is there, round it off to 25, you will get 59.3025 multiplied by number of units. Number of units, $50,000. 14,875. 14,875. It's a positive 14,875. It is positive for the customer point of view. For customer, it's profit. Therefore, it is payable by bank. Payable by bank to customer. It's a profit. Customer profit means for banker it is loss. So banker it's payable. Payable by bank to customer. Payable by bank to customer. New contract rate. New contract will be original rate only. What was the original rate? This will be nature will be original only. Original will be nature. Nature will be same as original. Nature same as original. And what was the original rate? Original forward sell. So it is going to be forward sell. And customer with a banker disadvantage position forward sell at a lower rate. What will be the forward sell? You want a new contract to be on 5th of July. So 5th of July, lower rate 59.6300. 59.6300 and lower rate, therefore margin you are going to subtract 0.01%. Sorry, 0.1%. 0.1% means 0.5963. 0.5963. So if I subtract 0.5963, 59.6300 minus 0.5963, 59.0337. 59.0337. Round it off to the nearest multiple of 25. Last two digits are 37. Multiple of 25 means 50. So it will be 59.0350. Point 0596. Oh, sorry, it's not 0.5963, is it? 59.63 into 0.1%. Oh, sorry, 0.05963. Oh, sorry, I missed it. Sorry, it's calculation error. It's 0.05963. So it will be 0.0596. So 59.63 minus 0.0596, 59.5704. 59.5704. So last two digits, nearest multiple 25 means 00. So rounding it off, 59.5700. Hope you are able to do it. Okay, let's go further. So let's come to next problem. Hope you got it. On October 1st, 2015, Mr. X exporter entered into forward contract with BNP Bank to sell US dollar 1 lakh on 31st December 2015 at 65.40. However, Due to request of the importer, Mr. X received an amount on 28th November. Mr. X requested the bank to take the delivery of remittance on 30th November 2015 before the due date. The interbanking rates on 20th November was as follows. Spot 1 month premium. If the bank agrees to take delivery, then what will be the net inflow to Mr. X, assuming that prevailing prime lending rate is 18%. Mr. X requested the bank to take the delivery on 30th November instead of 31st December. So what is the nature of transaction? Nature of forward contract disposal? It is early delivery. Settlement before due date. So in this case, you have to think from bank point of view. You cannot think from customer point of view. You can think from customer point of view, but we cannot explain the logical series of transactions. So let's think from bank point of view. What are the transactions the bank will enter into? Basic structure, you know, how do we write? Heading we give, bank point of view, then with customer, with interbank, date of signing, and due date. Date of signing on 1st of October 2015. On 1st October 2015. On due date 31st December 2015. An original contract. Exporter entered into forward contract to sell. They'll always confuse you like this. Exporter will sell, but we are writing bank point of view. So bank will do forward buy. Enter into forward buy at whatever is the rates, 65.40. And with the customer, with the interbank, you're going to opposite, of course, enter into forward sell at the rate not given at cover rate. If everything goes well, on the due date, you buy from the customer, sell it in the interbank as per the agreements. But customer is coming earlier, before due date, earlier to due date, before due date, customer is coming before due date, that is, he is requesting on 30th of November itself. You have to execute early. This is executed early, executed by at 65.40. Now, once you execute early, what should bank do? They can't do anything with themselves. They are going to do sell in the interbank market. They will sell in interbank market. Sell in interbank. Sell in spot. Interbank anyway heading. Sell in spot with the interbank. So bank is disadvantaged position. So you sell at a lower rate and margin also will not come. Sell in spot. But this forward sell is there. This needs buy. You've already purchased and sold also. Your hand is empty now. But cover transaction still need to be fulfilled. So what do? You enter into forward buy due which gets due date on same date. So on the same date, you enter into forward buy. Of course, it will be higher rate because you are transacting the interbank market. So you will have a forward buy, and this forward sell you can execute earlier, original forward sell execute. So this you can fulfill. That is the purpose. This can be fulfilled. Anyway, that will be executed as per the plan, and that is why it is not given. Anyway, so the difference between this sell and spot rate, this transaction, this sell and spot is called as swap difference. And buy and sell, that is a cash flow taking place. On this, you are going to charge interest on outlay. Interest on outlay. Anyway, this is the series of transaction. Solving the problem, I will not give you this format. You can follow this format. Sell in the spot lower rate, forward by higher rate. I have given to make you understand the process. You also check it out, and cover it anyway will be executed as per plan. That's why no impact overall. But anyway, take a look at this. Transaction wise, if you have any doubt, get clarified. How to solve the problem quickly in exam, I'll give a format. Okay, I believe no questions on this. So how to present in the exam to get the answer quickly, I'm going to tell you now. Now, there were three kinds of charges applicable: exchange difference, swap difference, interest on outlay. Now, in this situation, exchange difference do not come. Can you tell me why? In this example, in this type of problem, exchange difference do not come here. Can you think what could be the reason? Just think, when will exchange difference will apply? You will be able to get the answer. No, it can come before due date also. No, we have done problems where cancellation takes place before due date. Exchange difference has come there also. So before due date is not the question. What is the nature here we are doing? We are executing. I think that is the point. We are not cancelling. Cancellation before due date, cancellation on due date, or cancellation after due date. If you cancel the contract, exchange difference will come. You are not cancelling the contract. You are executing early. Contract is not cancelled. It is premature execution. Therefore, since there is no cancellation, exchange difference will not come, or early delivery. Remember, only two things will come. That is, swap difference will come, and interest on outlay will come. Only two things: swap difference, interest on outlay. So, if I give you a quick shortcut to remember how to calculate this, you are done. I explain the whole process of transaction to make you understand the full series of transactions. What bank do, what customer do, what they do with the customer, what they do with the interbank, how do they manage. theory, concept. But what is required in exam? Ultimate profit or loss payable by customer to bank or bank to customer. That's all you have to calculate. Okay. So for this, I will give you the formula. Formula also sometimes can be confusing. Buy, sell, spot, forward. It can confuse. Anyway, I've given you in the summary all the things in one place. But how to quickly grasp in exam, that I will tell you now. Swap difference. Swap is the difference between forward and spot. That you understand? One transactions we do in forward rate, one transaction we do in spot rate. One in spot, one in forward. Sir, how to do quickly? Take a look at this. It is definitely easy. I will tell you the quick shortcut and will apply in other problems also. Okay. Now, what was our original contract entered by the bank? Original contracts entered by the bank. That was forward by, right? Now, in swap also same thing. So, in swap transaction, remember, we will do one in forward and one in spot. Correct? Swap means that only. One rate will take from spot rate, one rate will take from forward rate. Okay, and both are okay. This is on date of settlement. Okay, this is on 30th of November 2015. One rate from spot we require, one rate from forward we require. That you are clear? One rate from forward, one rate from spot. Confusion is buy rate or sell rate. Confusion is buy rate or sell rate. Very simple. What was your original transaction? That will be your forward rate. The forward, same nature as original. Same nature as original. Means what? It is going to be forward buy, and in spot rate opposites. Opposite, it's going to be spot sell. That's all over. You have to do one transaction in forward rate, one transaction in spot rate, and the forward will be same nature as original. Original is forward buy, now also it will be forward buy, and opposite in spot market, spot sell. And remember, this is a transaction from bank point of view in the interbank market. Both are in the interbank market. So you will be buying at a higher rate and you will be selling at a lower rate and margin money will not apply. So if you can think faster, you can definitely calculate also faster. Anyway, in the problems when you do, multiple problems will do on this area, you will get practice. So on 30th of November, take a look at this. Oh, they are not given the forward rate also straight away. On 30th November, 28th November, both are same. Forward rate not given. 10 splash 15. Swap points. Increasing order. You have to add. So 65.22 plus 10. 65.32. 27 plus 15. 65.42. Okay. Now, you are forward buy at a higher rate. What is higher rate? 65.42, right? Buying at a higher rate. 65.42. And spot sell at a lower rate, spot sell lower rate 65.22. So swap loss 0.20, a loss because buy rate is higher, loss 0.2 multiplied by 1 lakh dollar. So you get in rupees 20,000. Loss for the bank. These are the transaction the bank is doing in interbank. Now interest on outlay. Again I'll tell you very simple. Now outlay, I need two rates. One rate is sell rate, other rate is buy rate. I need two things, sell rate, buy rate. Sell rate will be same as what I'm doing in spots. Or I will tell you other thing. It is difference between original forward rates, and spot rate. Spot rate will be same as what you did in swap. Same. So it's going to be original forward rate is buy, and this spot rate is going to be sell. We already used calculated, so no need to calculate once more. Sell rate and buy rate. Buy rate is at 65.40. Sell rate, this one, we already calculated 65.22. I think again you get loss because sell rate is high. So loss equals 65.22 minus 65.4, and this is interest and outlay. So you have to charge rate of interest at 18% for how many days? For this gap from the date of settlement till the due date, for 31 days, for 1 month. You can do 1 by 12 or you can do 31 by 365. Both are loss, interest cost, interest and outlay. So that will be 65.22 minus 65.4 loss into 18% into 31 by 365 into 1 lakh. Sorry, into 1 lakh also you should. Into $1 lakh. 275 something, 275. So this is a loss to be recovered from customer. 275 is the loss to be recovered from customer. And you are executing by, so 65.54 is amount payable to customer, right? You are executing. So net proceeds, if you calculate, net proceeds or net payable by bank. What is payable to customer? $1 lakh into 65.4. That much you have to buy. Means you have to pay them rupees. But you don't pay them full. You deduct these charges minus 20,000 loss minus 275 loss. Net amount is payable by bank to the customer. 1 lakh into 65.4 minus 20,000 minus 275. 65 lakh 19,725. Okay, so what is the trick in this case to calculate faster? To how to calculate swap difference, how to calculate interest and outlay. Swap difference, I need two things. One is forward, other is spot. For the forward, same nature as original, and the other is spot, which is opposite. Interest and outlay, original forward rate and spot rate. Spot rate is same as calculated in swap and original forward rate. Apply whatever the time period into the number of units. So in next problem and all, I will not explain this whole process. We are going to do it faster. I'll show you how. Of course, with practice, definitely you'll be able to do correctly. I hope it is done. I repeat that once more. Swap difference. Swap means spot and forward. Forward, same nature as original. Spot opposite. Interest and outlay, same original forward contract. Spot opposites. And both are the transaction done by the bank in the interbank. So bank will be disadvantaged position. and compute the time, whatever the time loss from the date of settlement before due date till due date. Exchange difference do not arise because exchange difference comes only when you are cancelling. Here we are not cancelling, we are executing early, not cancelling. Okay, let's go further. Hope you get more practice. I will read. An importer booked a forward contract with his bank on 10th April for US dollar 2 lakh due on 10th June at 64.4. The bank covered the position in the market at 64.28. The exchange rate for the dollar in the interbank market on 10th June and 20th June were given spot $1, spot June, spot July, spot August, spot September. So understand, as on 10th of June, as on 20th of June, these things to be understood as forward rates. Exchange margin 0.1%, interest and outlay of funds 12%, importer requested on 20th of June for extension of contract. The due date was 10th of June and he is requested on 20th of June. So it's a overdue contract. Due date over. After due date, overdue contract. On 10th of August, the rounded off to 4 decimals in multiples of 0.0025. The bank swap by selling spot and buying 1 month forward. Oh, they only have given actually. You're selling swap and buying 1 month forward. Calculate cancellation rate, amount payable on $2 lakh, swap loss, interest and outlay of funds, new contract rate, total cost. Okay, so first I will explain what bank is doing the transaction in detail, and then I will give you the shortcut. So just to understand the process of calculation, I am doing all these things. So with the customer, date of signing the contract. Okay, let me do one thing. Let me write it. So just to understand the process, okay. So bank point of view, overdue contract must be from bank point of view. Bank point of view. With customer, with interbank. Okay. So date of signing the contract, date of signing, then due dates, then cancellation date, after due date, cancellation date. In fact, there is an amendment happened which says cancellation will take place 3 days after due date. So if due date is 10th of June, 13th of June, the cancellation must happen. But anyway, in this problem, information is not there. It might be there in some other problem. It's recent amendment. Anyway, we'll look at that point later. So date of signing the contract is, when did you sign? On 10th of April. Date of signing, 10th of April. Due date, due on 10th of June. 10th of June. And he came, Aram say, walking on 20th of June. He came on 20th of June. Clear? Okay. So, with the customer, what transaction bank has done? Customer, importer needs to buy. So, the bank is going to forward sell, enter into forward sell, enter into forward sell. With the interbank opposite, they are going to enter into forward buy, enter into forward buy, which will be the cover transaction. On the due date, customer was supposed to come. He did not come. But you have to execute this agreement. So execute means you do forward buy. The cover rate, you execute this forward buy. But you are supposed to sell it to customer is not there. So instead of selling it to customer, you will sell it to interbank. So you are going to do spot sell at lower rate interbank. Bank is on disadvantage position. You are going to do spot sell. But in case customer comes, you should be ready with it. You're going to swap it. So you're going to do forward buy. Which date? All these things are happening on 10th of June. Due date. You are going to do spot buy with interbank at a disadvantage position. So at higher rate. Okay, on cancellation date, what do you do? You will actually cancel. And what is the cancellation? Either it was forward sell, corresponding transaction, it is going to be spot buy. And you are buying from the customer at advantage position. Therefore, it is going to be lower rates. And this difference that is forward sell and spot buy, this difference is called as exchange difference. What is exchange difference? For the purpose of cancellation. And here what you're doing, spot sell and forward buy, this is called as swap difference. And here what you're doing, that is a spot sell and forward buy, this is on this you are going to charge interest on outlay. So three kind of charges: exchange difference for the purpose of cancellation, swap difference for renewing your contract, and for the cash flow impact from the due date till cancellation date, you will have interest on outlay. Okay, this is just to make you understand the overall series of transactions what bank is committing. Logic to make you understand the logic. And exchange difference spot buy rate, here you will apply margin. Okay, margin will apply because you are transacting with the customer. Margin will apply. On swap difference interest and outlay, no margin will apply. That is transaction with the interbank. Okay, so this is just to tell you the series of transactions. But how to present in the exam, how to solve quickly in the exam, I have a shortcut for you. That shortcut you can learn in 2 minutes. You can easily apply in exams. I will tell you before that, you make sure you uh, write it here. And the logical part, if you have any doubt, get clarified. Okay. Now, now I'll come to the shortcuts. So please apply the shortcut. Very simple one. Observe carefully. What the bank will do with the customer, what they do originally, forward sell. And in the cover transaction, they do opposite, forward buy. On the due date, what they do, spot sell. On the due date, what they do, forward buy. And on cancellation date, they are going to do spot buy. And easy to remember, shortcut will tell you. You remember like this, SB, SB, B, SB, SBB. Once more, I'll tell you, it's a very simple shortcut. Listen to me carefully. How the bank will proceed. It's an importer transaction. Bank is selling the dollar to customer. So you start with forward sell. Logically, it's constructed. You start S, then short form SB. SB. B. Now, forward sell. So for forward sell, on the same date, they will do forward buy. Cover rate on due date, opposite of this spot sell, opposite of this forward buy, and from for the first one you're going to cancel spot buy SB SB B. Now difference between these two, the spot sell and forward buy, this is called as swap difference. From forward sell to spot buy, this is called as exchange difference. And forward buy where you execute, and spot sell, and this is called as the, on this you are going to charge interest on outlay. Write this shortcut. That's all you have to remember. Sell buy. You start with customer, you go to interbank, opposite on the spot date, on the due date, opposite of that, and on cancellation date from beginning to end. Forward sell, forward buy, for spot sell, forward buy, and spot buy. Now with customer, your advantage position and exchange margin will apply. And this one, swap difference interest outlay, this is with interbank. So you will not have any margin, no margin, no margin. Okay, now forward sell, original rate 64.4 given in the problem. Now cover rate given in the problem 64.28. Correct. 64.4 original rate, cover rate 64.28, both are given. I need to find out just the 3 more rates. They have given so much rates. I need 3 more rates. On 10th of June, spot sell. On 10th of June, forward buy. On 20th of June, actual date of cancellation. That will be spot buy. Okay. Now, spot sell will be what rate? Let's calculate. Spot sell on 10th of June. Look at this column only. 10th of June column only. Spot USD. And don't look at spot June. June means June end. We need to at spot USD. Spot sell. Sell will be at a lower rate. Bank is transacting in the interbank. Spot sell at a lower rate. 63.80. 63.80. No margin value will apply. Margin will come only in the exchange difference. Margin will not come in swap difference. Margin will not come in interest outlay. On due dates, that is on 10th of June, you are going to do forward buy. Forward buy on June end. We are in month of June. So June end you take it forward buy at a higher rate, which is this one, 63.9500. Then on cancellation dates, that is on 20th of June. This you are buying from the customer. Here your advantage position. So buying at a lower rate. On 20th of June, spot buying at a lower rate, 63.68. Here margin will apply 0.1%. You have taken a lower rate. So reduce further. If it is higher rate, increase further. So reducing further, 63.68, you subtract. Minus 0.1%. So this is going to be interest and outlay. This will be swap from beginning to end. That is going to be exchange difference. So 63.68 minus 0.10. How do you calculate? 63.68 minus 0.10% means 0.06, I think. 0.06368, 0.063, 63.68 into 0.1%, 0.06368, 0.064, no, 0.0637. So this will come to 63.68 minus 0.0637, 63.6163, and round it off. Look at last two digits, round it off to multiples to 25. So 63, closest one is 75. If it was 62, the closest would have been 50, 50, last two digits. 63, closest one is 75. So that is the cancellation rate used for exchange difference. Okay, hope it is done. That's first part of the question. Second part of the question, amount payable on $2 lakh. That is, what is the exchange difference? 64.4 minus 63 point, this 67.75. Amount payable on $2 lakh, nothing but you understand as the exchange difference. Exchange difference. And this is what you are selling at 64.4, buying at 60.6175. So it's profit for the bank. So loss for the customer. So this is payable by customer. That's what amount payable by customer. Payable by customer. It's a transaction. Exchange difference is a transaction between bank and customer, whereas swap difference, interest and outlay, is a transaction between bank and interbank. Okay. Next, third part of the question. Swap loss. Swap loss. This you know. Spot sell. I mean, 63.8 and 60.95. We already calculated. We already identified. Multiplied by 2 lakh 30,000 loss. Buy rate is high. This again loss for the bank in the interbank market. So recoverable from customer. Recoverable from customer. Okay. Next, part of the question. Interest and outlay. Interest and outlay we identified. 64.28, 63.8. You are buying at a higher rate, so outlay. If it is a gain, you will not pass it down to customer. Swap gain also not passed on to customer in overdue contract. Only exchange difference might be paid or received. So interest and outlay, 64.28 minus 63.8. That is buy rate minus sell rate. It's outflow, of course. On that $2 lakh, for 12% for 10 days. 10 days from 10th of June to 20th of June, from the due date till the date of cancellation. 316, again it's a loss. So it is again recoverable. It's a loss, so recoverable. Okay. New contract rate, I'll explain. First, you write down till here. Let me know if you have any doubts. These are the formats not available in any textbook nor in study material format. This has evolved in me over a period of time. So make sure you understand the shortcuts and formats clearly. If you have any doubts, you'll not be able to get clarified with other friends of other academies. This format will not be there. Okay, fine. Next, new contract rate. New contract rate, whatever is the original rate only. Okay, so original was forward sell, now also will be forward sell, renewal, extension, new contract rate. So what will be that? Standing on, they want extension on 10th of August. So on August, standing on 20th of June, renewal, expiring on 20th of August, 10th of August. I mean 10th of August, 12th of August, don't worry. Don't do worry about any interpolation method and all. Just August month is what they are given. Let's assume that whatever given is required. So 10th of August, so August month, 20th of June, you're standing on 20th of June. So August month, we have to choose either 64.18 or 64.25. Bank is selling. Selling will be at a lower rate. So 64.18 and margin will apply. You're transacting with the customer. So margin will apply. And remember on the forward rate 64.5, I have not taken margin even though it's transaction with customer. Why margin was not taken? Margin would have been already considered. Then this forward rate would have been earlier arrived. So when they tell you forward rate, you don't have to again add margin. But when you're choosing a rate, to determine the contract rate between customer and bank, margin should be applied. So 64.2500, sorry, lower rate. You're selling at a lower rate, bank advantage position, 64.18, and margin, what will you do? You will further extend the position. So lower rate, further lower rate. So you subtract minus 0.10%. So 64.18 or 64.25. What is that? 1 second. Oh, sorry, you are selling, right? Yes, bank is selling at a higher rate. I'm sorry, not a lower rate. Bank is transacting with the customer. Bank will sell at a higher rate. Importer will buy at a higher rate. You can think from bank point of view. You can think from customer point of view. Here, let's think everything from bank point of view. Bank is transacting with the customer. Bank is selling. Selling will be at a higher rate. Higher rate is 64.25 and margin even more higher rate, so margin will be added. 65.25, 64.25 plus 0.1. How did you get plus 0.1? 64.25 into 0.1 means 0.0642. 0.0642. So 64.25 plus 0.0642 means 64.3140. 64.3142 you get, and 3142 last two digits 42 and multiple of 25, last two digits 42 multiple of 25 means you get 50. So that's how you got 64.3150. Okay, then total cost will be all the charges, cancellation charges, swap loss, interest and outlay. Cancellation charges, it's a loss. So recoverable from customer, 30,000 swap loss recoverable from customer, interest and outlay recoverable from customer. So all are recoverable from customer. You can add all the three. That is 316, 30,000 plus 1,56. Add all the three. That is 1,86,816. Okay, hope it is done. Let's go further. On 1st October 2020, Mr. Guru, an exporter, entered into forward contract with the bank to sell USD 1 lakh on 31st December 2020 at 75.4. However, at the request of importer, Mr. Guru received the amount on 30th of November. Mr. Guru requested the bank to take the delivery of remittance on 30th of November before due date. The interbank rates were as follows: spot rate 1 month premium, assume 365 days in a year. If the bank agrees to take the early delivery, then what will be the net inflow to Mr. Guru, assuming that prevailing prime lending rate is 18% per annum? If Mr. Guru can deploy these funds in USD, he gets return of 3% per annum. Which is better and why? Oh, some decision making is also coming. I'll do that. But before that, in this problem, can you please tell me what is the nature of this forward contract out of 9 scenarios? On due date execution, on due date cancellation, on due date extension, or before due date execution, before due date extension, before due date cancellation, or after due date. Out of 9 scenario, which scenario this problem will fit into? This is early delivery before due date execution. And before due date execution means, three charges will be there: exchange difference, swap difference, interest and outlay. And out of these three, exchange difference will not come. We are not cancelling. We will have only swap difference and we have interest and outlay. And if you remember the method, the format I gave you, you can solve it quickly. We'll apply it here in this problem. So the first target in the exam is always which is the nature of the transaction. Once you identify that, it will be easy for you to look at it further. Okay, so this is again, let's solve from bank point of view. Bank point of view, a case of early delivery, early execution. two things will apply. One is swap difference, and second, interest on outlay. And one more thing I can do, that is amount cash flow on execution of the contract, and then overall cash flow. Cash flow on execution and overall cash flow. Overall cash flow. Okay. Now swap difference. What is the technique I told you? Remember the method? We will write one forward rate and I will write one spot rate. In interest and outlay also, I will have one forward rate and I will have one spot rate. And this forward rate will be original forward rate, original rate, exact original, and spot will be opposite. What is the original rate? Original contract, exporter will sell the dollar to banker. Banker point of view, they will do buy. So original will be forward buy at 75.40. They have the cover transaction, does not matter. Cover transaction matters only in overdue contract. Other situation does not matter. Spot rate, opposite. Spot sell at a lower rate. Now on spot rate, lower rate 75.22, because bank is transacting the interbank market 75.22, and this will be spot sell only, same thing. This spot will be same thing, spot sell at 75.22, and this will be forward, same original nature same as original, nature like original nature. What was the original nature? Original nature was buy. So this also will be forward buy on this date. What will be forward rate? At a higher rate, 75.27 plus 15, 75.42. Correct? You'll be buy at a higher rate. Okay. So this will be the swap difference. Selling at 75.22, buying at 75.42. I think loss. I think swap loss. 75.22 is the sell rate, 75.42 is the buy rate, multiplied by what is the US dollar? 1 lakh. So I think point to 20,000 loss of swap loss, 20,000 loss minus 20,000. Loss means it is recoverable from customer, because this is the loss incurred by bank in interbank, swap difference in interbank, interest and outlay in interbank, they have to recover. But if it was exchange difference, loss for the bank would be profit for the customer. So here also selling at a lower rate 75.22, this also is a loss. Interest on outlay is also a loss. 75.22 is the sell rate, 75.4 is the buy rate. You multiply it by $1 lakh, multiplied by rate of interest. 18% for how many days? From November to December, 365 days a year, so 31 days. 18% for 31 days. So 75.22 minus 75.4 into 1 lakh into 0.18 into 31 by 365 minus 275, I think, 1.18 minus 275.18, you can say. And this is also minus outflow, loss incurred by bank, recoverable from customer. Recoverable from customer. Okay, cash flow on execution. The bank has to sell, right? The bank has to export is going to give dollar. Okay, bank will buy dollars, original forward buy, and is going to give you rupees. So cash flow on execution, payable by bank, because they will buy the dollar, give the money. Payable by bank. Original rate, $1 lakh into 75.4. $1 lakh into 75.4. 75,40,000. So net cash flow payable by bank. Net cash flow payable by bank. They are export customer, so they'll give dollar, get the rupees. So we have to give rupees to them. We have to give them 75,40,000, but we'll deduct all these charges. Swap difference will deduct minus 20,000. Interest and outlay will deduct minus 275.18. Only the balance amount we will be paying it to them. 75, 19, 724. 75, 19, 724.8. Okay, this used to be the other questions as well, but in the question they have asked one more thing. Let's solve that. But before that, you make sure you do it till here. After all, it took 10 minutes. Typical problem. They've asked one more question. That's an interesting one. But anyway, first you write down till here. Okay. Okay, so you have done till here. Second part of the question, interesting one. Let's read. If Mr. Guru can deploy these funds in USD, he gets the return at 3% per annum, which is better and why? What is happening here? He received the money 1 month earlier and gave to the bank, and he did the early settlement. Instead of that, he can do one more thing. He is receiving the US dollar, keep it with himself for 1 month, and after 1 month, execute the contract as per this agreement. No need to go for early settlement. If the early settlement is not done, okay, but one small issue will happen there. What is that issue? You will receive 1 lakh US dollar and you deploy the fund. You can deploy these funds at 3% for 1 month for 30 days. and that US dollar will be converted into rupees after 1 month. Yeah, after 1 month you will convert it. But after 1 month, you will have $1 lakh plus interest, right? For $1 lakh, this agreement is there. You will convert it to rupees. That is no problem. But for the interest component, you don't have a forward rate. You don't have an agreement rate. So what do you do? On this the earlier date, you enter into one forward contract to sell that interest element USD which you are going to receive, that you will convert it into rupees by using the rate, forward rate, which you enter it today. So basically the customer has two choices. Let me show it to you. The customer received $1 lakh on November end, 30th November. He has two choices. One, encash it immediately. Encash immediately. That is what is early settlement, early delivery. And you will receive. If you follow this approach, you will receive. We have calculated 75.19, 724 rupees, 75.19, 724.82. You will receive it. One other option you have is encash after 31st of December. Encash after 31st of December. But if you encash after 31st December and execute as per original contract. Execute as per original contract. So you know early settlement as per original contract. But you will receive only $1 lakh. You are going to sell only $1 lakh. But if you follow this deposit, you receive it on 30th of November. So for 1 month, you deposit dollar, on that interest you get. For selling that interest component, enter into a forward contract today, which means what and all you're transacting on 30th of November. Let me do the transaction one by one. On 30th of November, you will receive $1 lakh from customer and deposits. And on 30th of November, you enter into one forward rate. Forward rate for selling what you're selling for interest component. For $1 lakh, you have the contract, but for interest component, for selling interest component, how much ever we get, we know now itself how much we get. We are going to enter into a forward rate. At what rate? You're selling dollar at a lower rate. Forward rate will be lower rate, 75.22 plus 10. Swap points increasing, we are adding. Hope you know it. 75.22 plus 10. Lower rate because we're selling at a lower rate. No margin money. Oh, margin money is also a question. Actually, we can also think about margin money. Okay, that's the one interesting one. Margin also can be applied. But anyway, Institute has not done like that. We can do directly. 75.22 lower rate. 75.22 plus 10. 75.32. 75.32. Here, actually, margin also can be applied. You can add margin. I would recommend. But anyway, Institute is what has taken this. So on 31st of December, what and all you are going to do? $1 lakh, you sell using original contract rate, original forward rate. What was original forward rate? 75.4. That is, you will receive 75 lakh 40,000. We already calculate also. 75 lakh 40,000. And interest you receive, interest on USD. Interest on USD that you multiplied by new contract you enter into, new forward rate. Actually, margin should be subtracted, but I don't know why Institute has not done it. So, on $1 lakh, they said 3% you can deploy for 1 month or for 31 by 365. So, how much dollar you get? $1 lakh into 3% into 31 by 365. 254.79. 254.79 multiplied by the forward rate 75.32. 254.79 into 75.32, 19,190.78. 19,190.78. So you can do the total. That's what you're going to receive after, if you follow this approach on 31st of December after 1 month. 75 lakh 40,000 plus 19 lakh 19,190. So 19,190.78. 7559 190. 75 59 190.78. So they say here 75.59 you get, 75.19 you get. So encashing after 1 month is better, but I have one problem in this solution. When you receive the money on 30th of November, that can also be deployed, but USD 3% will generate. How much this will generate, we don't know. So this has to be added with interest for 31 days. But I'll write 0 because no information. No information. So what will be the equivalent amount after 30th of December, 31st of December? Same amount, 75 lakh 19,724.82. So comparatively, the encashing after 1 month is beneficial. This is beneficial. Encashing after 1 month is beneficial. That's what Institute has told. I see two flaws in this solution. One solution, I think they should have applied the forward rate commission here. Margin they have not considered. They should have considered the margin money on this. And second, interest on this is not given. They have given lending rate 18%, but that's for a lending, not for inflow. So I don't know deposit rate. So deposit rate we don't know. That's also missing information. That's also I consider it as a flaw. But anyway, which is beneficial? Keeping the data available, encashing after 1 month is beneficial. Okay, so this is about the early settlement along with the decision making. Interesting problem.